Welcome. This is ProFormaStabilized Spreadsheet Distressed Analysis Video Tutorial number 2. My name is Jeffrey Smith. This is the Distressed Analysis Summary Worksheet. I want to point out that under the Repositioned Unit Cash Out Return, you can specify a desired simple rate of return on a refinance to cash out your private financiers after completion of the project. For example, if you specify 100%, you'll see that the investment per unit price is $15,008 and the cash out they get is $15,006. That's 99.99% simple cash out at completion of the project through a refinance. You can do what-if scenarios. For example, what if you wanted to give your private financiers 150% cash out on a refinance? You will see that the annualized rate of return is now 48% a year. This is a 15-month project. You'll see that the after repositioning value does not change because the ARV operating data does not change. What is changing is the pro forma net cash out. This is handled through a complex equation that determines your cost of financing to get into the project as well as funding the syndication parameters and then working backwards to redeem the senior financing tranches. The maximum allowable offer plus the total rehab costs equals the financed investment to value. There is additional funding to come to the total investment to value, which is the additional funding in the syndication LLC, the parameters, and the debt reserves. Now this is Microsoft Word. The ProFormaStabilized Private Equity Repositioning Mail Merge template. Always select No on this requester because Word is looking in the wrong folder. Alt-MRE. We can specify where the CSV file was saved for the spreadsheet. Alt-MP will preview. Let's do a print preview. Now we can see the actual operating data coming into the project. We determine that we're borrowing 70% of the financed investment to value, and we have a preferred equity investor in second position for 20%. The common equity private financiers are bringing in 10% of the financed value. Subtracting the repositioning cost yields the maximum allowable offer. We then have detail lines for the first position financing and the second position financing, as well as the blended financing. We then calculate the after repositioning value. This is according to the anticipated refinance parameters: 6% annual interest rate, amortization term 300 payments, that's 25 years. We see that on the refinance the equity return multiple is 1.50. That means on the refinance cash out, along with the cash flow during the project, the private financiers have received 1.5 times their investment, and they still own the property with positive cash flow. And the cash out is tax-free because it is proceeds from a loan that they can roll into the next project. The membership summary for the limited liability company, we show we're bringing in $10,000 for the operating reserves, $8,000 for closing costs, syndication premium fee $12,000, The total syndication entry costs are $30,000. We're also bringing in an additional 3 months of debt reserves. The common equity investment is 10% of the financed investment to value. The total funding raising for the membership LLC is $169,207. When we calculate the total repositioning costs, plus the maximum allowable offer, plus the reposition equity investment, we come to a total investment to value of $1,156,636. We've set up the LLC to have 20 membership units, reserving 40%, that's 8 units, for the syndicator, and selling 12 units to our private financiers. The cost per unit is $14,101. That's 1.22% of the total investment to value. Now on the cash out, the refinance cash out total is $366,576 after redeeming the future value of the first and second senior tranches. The syndicator is receiving 40%. The financiers are receiving 60%. The refinance cash out per unit, $18,329. That's approximately 130% of what they put in. So they're getting all their investment back plus another 30%, and they still own the property with positive cash flow at $349 per month per unit. If we sell the property instead of refinancing, we assume that there's about 7% of the after repositioning value for the cost to sell. That's closing costs, escrow costs, prorated, and realtor commissions. We get a gross proceeds. We subtract the repositioning financing. That's the first and second tranches. We get the net proceeds, and then we subtract the distribution to the syndicator, 40%, distribution to financier, 60%, distribution per unit and analyzed yield. That means each membership unit is receiving $44,189. That's 104.78%. The distribution equity return multiple, 3.33. That means they're getting 3 1/3 times as much as they put in to the deal. That's a very good multiple. You can do what-ifs with this spreadsheet, changing the various ratios and percentages, being sure to save as a CSV so that the updates can be carried over into Microsoft Word Mail Merge. This has been ProFormaStabilized Spreadsheet Distressed Analysis Video Tutorial number 2. My name is Jeffrey Smith, and thank you for your support.